So, Archer Daniels Midland reported earnings today. And, as is tradition on Wall Street when the narrative turns sour, the reaction was absolutely ruthless. If you looked at your screen this morning, like I did, you saw red, deep red. The stock was down 11% at one point. It felt like the floor had simply vanished. I managed to catch the falling knife and bought a little into the panic. The price recovered a bit by the afternoon, trading stabilized, but honestly, I am not convinced the pain is over. I have held this company in my portfolio for nearly 3 years. It has been a boring, reliable tenant, a sleep well at night stock. I remember buying heavily around the $47, $48 level, thinking we had found the absolute cycle bottom. Then, when the euphoria took it to 60 and even 70, I did the rational thing and sold a significant chunk. That was the easy part. Selling into greed is easy. Buying into fear is hard. And today feels different. This doesn't feel like a simple market overreaction. It feels like a fundamental repricing of the business. Part 2. The headline paradox. Let's strip away the noise and look at the actual numbers, because there is a massive paradox in this report. On paper, if you only read the headlines, you might think things are fine. ADM reported adjusted earnings per share of 87 cents. The analysts were expecting 80 cents. So they beat expectations by 7 cents. A beat, right? Wrong. Look at the revenue. Total revenue collapsed to $18.56 billion. That is a miss against expectations. But more importantly, that is a massive 13.7% decline compared to last year. Let that sink in. The company beat profit expectations while shrinking its top line by nearly 14%. What does that tell a seasoned investor? It tells you that the company is in defense mode. They are cutting costs, squeezing efficiencies, and managing the bottom line because the demand side, the growth side, has fallen off a cliff. Part 3. The segment Autopsy. Why is it bleeding? To understand why this is happening, we have to open up the hood and look at the engine. And the engine is sputtering. Let's look at the core segment, ag services and oil seeds. This is the heart of ADM. And operating profit here fell by 31%. 31%. Why? It's no mystery. It's a structural shift in global trade. North American soybean exports are weak. Why? Because global buyers, specifically China, are ghosting the United States. They are shifting their purchases to South America, to Brazil. This isn't just a bad quarter. This is geopolitical. And then you have the crush margins. We're seeing a flood of imported used cooking oil, or UCO, coming into the market. This cheap supply is crushing the margins for domestic vegetable oil. ADM is getting squeezed on both ends, lower export demand for beans and lower pricing power for oil. Then look at carbohydrate solutions. Profits down 6%. Ethanol margins down 10% compared to last year. Why? Because the industry built too much capacity. Inventories are high, demand is flat. It's economics 101. Too much supply, not enough demand. And finally, nutrition. This was supposed to be their growth engine, the future, the high-margin business. Profits down 11%. The flavors business is weak because people are buying fewer beverages. So when you look at the board, ag services down, carbs down, nutrition down. There was nowhere to hide. Part 4. The dividend disappointment. Now let's talk about the dividend, because this is usually why we hold stocks like ADM. They announced a dividend increase. Great, right? They raised it by 2%. 2%. Let's be real. Official inflation might be 3%. Real inflation is probably 5 or 6. When a company raises its dividend by 2%, that is not a raise. That is a pay cut.
That is your purchasing power slowly eroding while management pats themselves on the back for their 53rd consecutive increases. It tells me that management is scared. They're hoarding cash because they don't know what 2026 holds. Part 5. The 10-year view. The cycle turns. As a student of cycles and following the philosophy of Howard Marks, I like to zoom out. 1 quarter is noise. 10 years is a signal. I looked at the data going back to 2016. In 2026, at the peak of the cycle, ADM had a return on equity, or ROE, of 18.6%. They were printing money. Today, at the end of 2025, return on equity has collapsed to 5.2%. That is well below the industry average. It means for every dollar of shareholder capital, they are generating a fraction of the profit they used to. And here's the trap, the value trap. Historically, ADM trades at a price-to-earnings ratio of around 15. Today, even after the drop, the PE ratio is sitting at 27. How is that possible? The stock price went down. It's possible because earnings fell faster than the stock price. This is called PE expansion, and it is dangerous. It means you're paying more for less earnings. If you compare this to their competitor, Bunge Global, which trades at around a PE of 12, ADM looks expensive. Part 6. Management and a future. So, can we trust the pilot flying the plane? Management has been under fire. Accounting scandals, restatements. The good news is they hit their revised targets for 2025. They promised savings of $200 million, and they delivered. But their guidance for 2026 is soft. They are projecting earnings per share between $3.60 and $4.25. The market was expecting $4.24. So the best case scenario for management is the base case for the market. That is not a recipe for a stock price rally. They are betting on policy changes. They are waiting for the U.S. government to clarify the 45Z biofuel tax credits. If the government gives them a favorable ruling, yes, the stock could rip higher. But do you want to base your investment strategy on the whims of politicians in Washington? Pause. Part 7. The verdict. So, where does that leave us? My gut tells me the true cycle low is still ahead of us. The technical charts might show some support here, but fundamentally, I think the price wants to retest that floor I mentioned earlier, $47 to $48. At that price, the value yield becomes attractive again. At that price, the margin of safety returns. But why am I still holding? Why didn't I sell everything? Because of one simple fundamental truth. Food does not fall from the sky. Right now, the agriculture sector is unloved. It's unwanted. It's trading like toxic waste. But the population is growing. People need to eat. The demand for protein is not going away. We're seeing a cyclical low, not a secular death. The pendulum is currently swinging towards extreme pessimism, and as Howard Marks teaches us, that is usually the time to be interested, not the time to flee. I also hold Bunge Global in the same sector. I suspect their metrics might look better because they are less exposed to some of ADM's specific internal issues. But we shall see. Conclusion. If you are holding the bags like me, I rate this a hold. Don't panic sell at the bottom. If you have cash and you want to enter, wait. Let the market throw its tantrum. Let the price come down to the low 50s or high 40s. Be a sniper, not a machine gunner. The value will return. The cycle will turn. But winter in the agricultural market might last a little longer than we hoped. Drink your coffee, watch the screens, and stay patient. Atlas Shrugged, signing off.